All right, everyone, what's up? It's Eric from Option Edge, and today's video is going to be talking about trading earnings. Okay, so the basic premise behind trading earnings, the smart way, is using the implied volatility to calculate the expected move, where the stock's going to go after earnings, and using that to our advantage. So basically what happens is 80% of the time, the expected move, the volatility of these for these different options are going to be overstated. So by selling premium around outside of the expected move, either with a strangle, a naked strategy, that's a call and a put, selling a call and put, or a iron condor, which is just selling a put spread and a call spread around the expected move, or even a butterfly strategy. So basically, what's going to happen is we bracket the upper bound and lower bound of the expected move, and 80% of the time, this is based on historical data, the expected move is going to be less than the theoretical expected move based on the options implied volatility. Okay, so let's get into the meat and potatoes, and we'll dive deeper into what I'm talking about here. All right. Okay, so to explain expected move, let's look at the expected move formula. So there's going to be three variables: the stock price, the implied volatility of the stock, and the days till expiry, or the calendar days. So basically what's happening here is your implied volatility is an annualized number. So the percent that you see, I'll show you the percentage here. So as you can see, there's implied volatility percentages on this. This is an options chain of Roku, showing the different expiries and the different the number of days until they expire, and the implied volatility associated with those different expiries. So basically, what we have to do is normalize the implied volatility for the number of calendar days we're looking at. So we're going to insert the number of calendar days, insert the implied volatility, insert the stock price, and that's going to spit out the expected move. Okay, do this, and here's another interesting visualization of the expected move. You can see each expiry has a price range, and I'll show you how to calculate that. I put together a little calculator on Google Sheets. Okay, so let's go there and do that. Okay, so I put together a little expected move calculator that contains the formula that I just showed you before. So Roku is currently trading at $233. We're going to use this is the date, this is the expiration date, this is the amount of calendar days there is. So we populated 26 there. So we have our days, we have our implied volatility, and then we have our stock price. And this is our expected move, so $35. So $35 gets added to our current stock price to give us our upper bound with a 68% probability. And then you also subtract that $35 from 233 to give us the lower bound with it. Okay, let's take what we just learned with Roku and let's apply that to a stock that's going to have an earnings announcement in tomorrow. So that stock that I'm looking at currently is Autodesk. So let's calculate the expected move. I'll open up my Google Sheets and we'll look at how that works. Okay, I took this from Tasty Trade. The current volatility is about that. Stock price trading at 30.38. So and 3 calendar days. So we're looking at a $25 expected move. So I want to set my lower bound at 275. I might put it up at 280 just to give me more of a bullish emphasis, and then I might sell a call spread above the 325. Okay, so let's look at that. So let me go to. All right, so let's go to Autodesk, currently trading here, trade options. I'm going to select the nearest term options. So I'm going to do a put, and I'm going to do, let's do a bullish tilt, and we're going to make it 1,000 wide. All right, so we're risking that much to make. So we're going to say, let's say we want this at 130. All right, sell that 131, boom. Sell that, and then let's go and we said 325 to the upside. So we're going to sell it at a call at 330 and then make that We're gonna have a slight, so it's gonna be only about that much. Let's do 1,000. All right, so we got a slight bullish emphasis on the call spread side as well. Sell that. Cool. Those aren't filled yet, but you get the idea. Okay, so just to recap, what we just did in Autodesk is we more or less created a iron condor with a bullish skew. So what I did was I took a put credit spread. I set it, originally I was going to set it right outside the expected move. Since I have a little bit of a bullish expectation on the stock, I shifted the put credit spread a little bit inside that expected move, okay? Then on top of that, the upper bound, I sold a call spread that was outside the expected move, okay? So that is a iron condor. You could have also sold a strangle, meaning just a naked put, sell a naked put below the expected move, and then a call spread, or excuse me, a naked call above the expected move on the upper bound. So I'm making this video actually after Autodesk earnings, and so here's the results. The results of the trade were, it was a loss, and Autodesk went well below the lower bound, about double the expected move. The expected move was about what, 20, 25. It had about a $40-$45 expected move. So that happens, you do lose, but over time, if you keep doing this strategy, since, like I said, the expected move is overstated, and if you sell premium, you should over time, theoretically, win more and collect and profit more than you're going to lose. And ultimately, it's a profitable strategy doing this type of stuff. So something to keep in mind. But yeah, that's more or less how I set up my earnings trades. So I'm using that expected move, selling premium, either call spreads, put spreads, or naked calls, naked puts outside of that expected range, and collecting premium and letting the volatility of the options decrease after the binary earnings. If you have any questions, please let me know. I've made videos more about how to calculate the expected move. It goes into more detail, so please watch that video. I'll link to it above. But yeah, that's it. And yeah, like and subscribe, and thank you for watching. And this is not financial advice.